putting on in our Monday class. So go ahead, Dawn. Sorry to interrupt.
Great, great, great. So I just started to record, and you see my screen. I'm sharing my presentation, yes?
Yep.
Cool. So today, our topic is profit from market movers. Profit from market movers. And Dan and I started Options for Wealth a few months ago. Those of you who don't know me or are meeting Dan for the first time, I just want for you to know that Dan is a dear friend. We worked together a few years ago, and he's the reason why I moved to California. He helped me find my apartment here, and I've mentored under Dan, and all I can say to all of you who are on the phone, he is a mastermind as it relates to how the markets work, and specifically how to leverage your investing and trading through options, which will turn up the volume on your rate of return. So,
thanks, Dawn.
Yes. So what I want to touch on today, just for all of you that are with us, I'm a little bit older than Dan. I turned 56 last week. Can you believe it? 56. I don't look a day over 55, right? So I've amassed wealth over my career. I sold a company, made a considerable amount of money. And like everyone else in my generation, I relied on brokers to give me advice. And here's what I can tell you. I've spent tens, hundreds of thousands of dollars paying brokers to lose my money for me. So when I came to Dan, I said, stop the madness. I want to take control of my portfolio, and I want to grow and protect my accounts while creating income through trading the leveraged asset classes. Because I don't know if you all know, if you just trade stock, there's a lot of limitations. It's very pricey. Also, if you need at least $25,000 in your account. And there are account needs on the option side as well, but it's easier to get into. So here I am managing my accounts. We've had an S&P 500 that was up like over 300% from 2009 to where we were on February 19th. And you all probably have seen over the past month extreme swings. So those of you who are doing things, the old-fashioned way, like what I used to do, rely on brokers or have my money in mutual funds. What you're doing right now is wishing, hoping, and praying everything goes up. And we have a different approach for you, which is taking this opportunity of volatility and making money in uncertain markets. And I'm going to show you someone like me who was just a few years in that old way of being is now profiting from new strategies. Dan, I don't like sitting around and wishing and hoping and praying. I don't think that is a strategy for success.
Hope is great. Hope is great, but again, hope is not a strategy, right?
Hope is not a strategy, right? So before I get into what I'm getting into, and Dan, we always repeat this, no statement in what we are presenting today should be construed as a recommendation to sell or buy anything, okay? Leverage can work against you. You must be super confident, understand these strategies, and certainly set up a simulated account, right? And use monopoly money to do what it is that we show our students before you risk $1 of your account. So if you aren't aware that risk is associated with trading and investing, we ask that you seek advice from independent financial advisors. We are not independent financial advisors. We are people like you who want to get smart around making progress and profit in all markets. Anything you want to say about that, Dan, before we get going?
No, one nugget to add though. Just like if I'm showing a trade or Dawn's showing a trade, we'll tell you whether we've taken it or not. I mean, I don't know, I haven't seen Dawn's presentation yet. If everything that I'm going to show you, we talked about it on Monday. I either have it on my account or we have it on the simulator for our Monday class. So the real trades, right? Everything's real. It's just legally, right? We're not allowed to be up here and say, listen, hey, take this trade. It's a winner. You understand?
No, this isn't Boiler Room.
Yeah.
Remember that movie?
Yeah.
Okay. Dan, I came across this quote this morning from one of my email. I have many sources that I subscribe to, and we have vetted resources that we tell our students about. And one of my resources is Zacks Investing. And Jeremy Mullen had this quote today. Let's take what this market is giving us. Remember, no position is safe in this environment, and the strategy is to take profits. Be an assassin, hit and run. Do you love that statement? Be an assassin, hit and run. So what does this mean? What this means in this market is we want to gauge volatility. And if you're looking at your portfolio, and this is what I'm going to talk to, adapt your portfolio and trades to reflect short-term trends. And number two, be intentional with setting profit targets and what you're willing to lose with every decision you make. Okay, right on. So what am I doing in my portfolio? What am I testing out? Here's what I'm testing out. And this is a strategy that comes directly, again, from another resource partner. He's kind of kooky. His name is Roger Scott, but he has a program called Nasdaq Titan that I've been testing. And I'm going to share with you how it's been working. And his program is all about, instead of looking at individual trades, set aside a certain amount of money and create a portfolio that you're going to adapt every 2 weeks based on what's going on in the market right now, which are leading indicators: relative strength, correlation, volatility. Okay, so we're talking about an overall approach, which the intent is to level the playing field between retail and institutional trading. So market timing methods. We want to react to what the market is currently doing rather than what it did previously. So the concept is all about hedging for growth and protection. Hedging for growth and protection. So we want to determine some movers, some short-term movers that have relative strength, more strength than what's happening within the index that they're a part of. So on the stock side, we're looking for movers, and these are all long positions, Dan. Okay, these are all long positions. So we're going to be talking about taking advantage of the bull call spreads, so we can turn up the rate of return through options rather than just buy the stocks directly or the ETFs directly. Okay, so what we want to have in our portfolio is an inverse product to what the US stock market's doing. And in this case, we want to consider the long-term bond ETF. Dan, I love ETFs. I was just on the phone with a broker that I previously worked with, and all of the financial planners out there and brokers are blaming ETFs for what's happening in the markets. So all I have to say to all of you are ETFs, exchange traded funds, offer amazing opportunities. It's what we trade in options for the most part. And in this particular strategy, we're referring to, you don't have to go out and buy bonds. There are ETF products that will allow you to hedge your particular portfolio. Okay, so what does this look like? This looks like choosing stocks that are stronger than the index that they're part of, and downside risk addressed through long bond ETFs. So what this program is all about, that I'm a part of, and if you're in our mastermind on Mondays, if you are looking at long-term investing, it's something that I would recommend that you be a part of in our mastermind. Every 2 weeks, experts decide whether we're in a mildly bullish market. And in that case, we're going to have a 25% across the board allocation between the bond ETF and the 3 particular stocks that are outperforming the index that they're within. an aggressively bullish market, we're going to reduce the bond positions and increase the stock positions. In a neutral market, it's a 40% in 2020 on the stocks. And then, you know, what we're looking at, I don't even know what I would call what we're looking at today, because it's just extremely volatile. I don't know if they've declared it bearish for the long term, but you can see that in the bearish markets, we're increasing our bond positions, okay? So just to show you what I put on, okay, on March 16th, I took these recommendations. And what you're seeing here on the screen is from my spreadsheet. So before I put on these positions in my Thinkorswim account, what I did was I looked at TMF, which is the bond position. It's the bond ETF. And I'm not going to go into what these other stocks are. There's a technology play here. There's a coronavirus pharmaceutical company here, but the three stock positions were JD, GILD, and TTWO. So at that time, you see, like, determine your portfolio size. To try this out, I tied up $25,000, Dan. So you could see on the bottom here, I tied up $25,200 based on the debits that I saw for each of these vertical positions. So you're going to get specific strike prices for the vertical positions for these items that we have in our portfolio. So all I'm saying here is to put on all these trades. I tied up $25,200. With me so far, Dan?
Yeah, and you did. These are all options positions, correct?
Options positions, because I wanted to turn up the rate of return. Because if I just went out and bought the underlying for these, my rate of return would have been so much lower than what I saw. So what I'm showing people here is that you can use options for intentional investing, as well as what Dan is going to go through, some income plays for short-term profiting. You with me so far? So yeah. My intention with this portfolio is every 2 weeks to roll over what it is that I'm making in the portfolio. So it's going to compound, right, exponentially. And I'm also turning up the rate of return through options. So ta-da, here is where I am today, which is incredible, especially when you can look at what the SPY did. The SPY closed at 239.85 on the 16th of March. As I'm looking at my screen right now, it's right now at 247. You know, at 10 minutes ago, it was at 245.78. So we're looking at about a little over a 2% increase, right, in a week. Did I do my numbers right, Dan? Okay.
That's right to me, yeah.
Yeah, I'm an electrical engineer, and I still, you know, question my numbers. But here's the wild thing. At the time that I looked at my portfolio this morning and did this slide just 30 minutes ago, you can see this. This is a screenshot directly from my Thinkorswim account, okay? So I realized a $4,600 profit on top of the $25,200 that I set aside in this particular strategy. And in a week and a half, I'm up 18.46%. How incredible is that compared to what the market did this week?
It seems like you're really able to juice those returns.
Yeah, through options. So these are the kind of things, if you're wondering like what Dan and I show our people in our mastermind, and Lauren's on this call, what we show our students and the education that we take you through and the implementation of strategies in simulated accounts. The first thing we have our students doing is opening up a Thinkorswim paper account. Thinkorswim is aligned with TD Ameritrade, and it's an amazing platform that we use for analysis for our options trading. So I'm just going to stop sharing right now. And I would just like, for those of you who are with us, oh my gosh, I see some blasts from the past, some amazing friends that I haven't spoken to in a while here. Can you just type in the chat and tell me what you thought of this strategy that I just shared with you? The intent is to see movement like that, to see rates of return like that or in that same ballpark every 2 weeks, because we're doing adaptive investing. Every 2 weeks we're shifting around those stock positions based on the movers that are showing up depending on the market, and then hedging the particular portfolio with a bond ETF. Okay. So guys, if I could do this, anybody can do this. I'm not a brainiac like my colleague here. Dan, I think he's been trading options since he was, what, 5 years old?
I started when I was about 17. But.
When he was 17, he's been doing this for a very long time. So I'm going to hand the floor over to you. And again, I would love anybody who's with us here today to tell us what you think about what we're sharing. And you can email us. If I'm Dawn at optionsforwealth.com, and Dan is Dan at optionsforwealth.com. That's our brand. So you're going to start. Take it away.
Everybody's got, can you see my screen okay?
Yeah, seeing it great.
So I'm going to go in a little bit more granular on what some of the things we covered on Monday's Masterclass look like, how they're doing now. Referencing some of the trades we put on last week, and really just dig in at sort of a deeper level on like an options chain level. So largely what we're going to talk about today is the market volatility index here, the VIX, and how that impacts the overall of how I'm positioning myself, how Dawn's positioning herself in these options trades. You know, Dawn said earlier, something to the effect of, this is the time. Right? Volatility is opportunity. We want to be assassins. Something to, like, I didn't get the quote exactly right, but that's the overall premise of this presentation, right? Volatility is higher than it's been in the last 10 years, right? And we can really capitalize on that situation as traders. We have advantages as individual traders that these big banks and institutions, these big market movers don't have, right? We're very nimble, we're very agile, whereas they're a freighter, and they have the opportunity to make a wake and move markets. We're just a little jet ski ripping along beside them, and we can turn on a dime, and they can't. So
we're the jet ski, and they're the tanker.
yeah, and so that's the advantage, right? That's the hidden advantage in all this that we have. So let's get into it. So I'm going to talk about, again, I covered this last week, but again, I'm going to hit the basics of the VIX. What is the VIX? Then I'm going to talk about the VIX play that we had on. Then I'm going to get into, I'm going to flip over to the TD Ameritrade platform. I'm going to talk a little bit about technical analysis. Specifically, the topic for this week is the Fibonacci. I really like using the Fibonacci retracements as sort of a guide, as like areas to focus on in the markets. And then I'm going to go through the bull put spread play review that we did on Monday. Same legal statement. The trades I'm showing you, we've taken, they're live trades, right? But not making recommendations to buy or sell an individual security, okay? This is a learning exercise. So the VIX, the CBOE Market Volatility Index. So the VIX, let me pull up actually the chart of the VIX. The VIX is essentially the scaredness. Can you guys still see my screen?
Yes.
The VIX is, a scaredness index of the market. For a newer options trader, I would say think of it like that. The VIX represents how scared the market is. Now, that is represented by the demand for puts and calls out of the money. What does that mean? The VIX is currently at 61. Okay, it's an out of the money call, right? In this case, would just be a call greater than 61. An out of the money put would be a put below 61, right? So when the markets are buying, and people in the markets and big funds in the markets are buying insurance to protect themselves in case of a crash or in case of a sudden surge, right? the VIX will reflect that and spike. And you can see over the last year, we really topped out at around 24, right? In the VIX.
Yeah, we were seeing swings between like 11 and 24 for, right?
Yeah, and even for a while, I mean, it went to kind of a sleeper here. If I go back out 3 years, you know, this was in February of 2018. I know because I was running my hedge fund at the time. So I remember that very, very
oh my God, I remember that day. I remember that day.
But beyond that, I mean, you know, it was as low as 8 for a while, 8.5.
And there's Christmas, you know, 2018, right? Right over there.
This was when we had the worst December, you know, at the time in, you know, 100 years, you know, and then, you know, little peaks and peaks and peaks. You know, every time Trump goes off on something, there's a peak. But, you know, that's okay. Like, these are just little movements that your portfolio can absorb these. What your portfolio can't absorb, right, is this. 1,000 points down in the S&P 500 in 2 weeks, right? So that's where options come in. This one tick, ignore that tick. Just as an FYI, that's just TD not plotting correctly. The VIX never went down that low. Something to just remember. But what the opportunity that we're given when volatility peaks this high is that naturally, mathematically, and historically, it has to regress. There's no way mathematically for volatility to stay anywhere near 85. Like, for it to stay at 85, the markets would have to fall by 10% a day, like for weeks in a row. And I mean, hey, that can happen, right? But we've got bigger problems if that's happening. There is no more market if that's happening. But aside from that, there's no way we can stay elevated this high. So with that in mind, we put on a play about a week and a half ago that will capture profits as the volatility index itself falls into what I've highlighted here as this zone, 60 to 35. It's called a butterfly play. If you guys want to look up on your own what a butterfly is, it's a put butterfly. You know, we're going to cover that on Monday in our next class. But essentially, it gives you a profit zone that looks like this, right? I don't know if you guys are familiar with the profit graph, but what this graph is expressing, this blue line at expiry with $3,100 worth of risk on this trade, profits, you know, to a max of about $11,000. Now, $11,000, you know, that's if we hit it right on the nose. More likely, we're looking for about a 30 to 50% return on this money within about 3 weeks. Sounds good, right? You know, this is not a play you dump your whole portfolio on, right? This is a play where you isolate, you know, maybe 10 to 20% of your portfolio for quick hitting, you know, assassin type plays like this. The play is listed down here. You can follow along if you like. And my favorite part about options and options in general is you're never out of the game. So if I see volatility falling, right, I'm in a good spot right now for this. So volatility, this is pricing on the April contract for volatility. We're sitting like right here. The date's wrong, but you know, it's a nice play. It's currently up about $1,500. You know, and we're looking good. But if I thought that the markets were just going to go back to normal and go to sleep over the next week or so, that would result in the VIX falling out of my profitability zone. So we would take a defensive position, and add this small play to the mix. And voila, what does that do? Well, that gives me flat profits to the downside, no matter how low the VIX goes. Right? So I'm not going to dig into like the nitty gritty of like what this looks like. This is a moderately advanced adjustment type play to this position. I just want to make the point that, and I can do the same thing on the other side. I want to make the point that, you know, there's always an adjustment you can make to kind of wiggle yourself out of a bad situation with options. If you know what you're doing, think of trading options, especially the more active type of options trading that I'm doing. It's like playing a chess match, right? Against the computer. You have your, you know, if the market does this, then I do that. You know, if the market does that, then I do this. And you have these defensive counters that you can do to keep yourself in the fight. And this is what newer options traders struggle with the most, right? They do one of two things. They hold the position and they hope, right? We talked about hope is not a strategy. They hope that it comes back and, well, it'll just, if it's just here at this date, then I'll be fine. And as long as it comes back, I'm good. So that, number one, we don't do that, right? That's not the strategy. Number two, they don't know how to make adjustments like this to limit their risk. The point of managing a losing options trade is not to turn the losing trade into a profitable trade, right? The point of managing a losing options trade, and this is really important, like if you're going to write down anything from my presentation, write down this. The point of managing a losing options trade is to manage that trade back to break even, not to make that losing trade into a winning trade. Now, this trade is good. It's not a losing trade. It's making money. Don't really need to do an adjustment right now, right? But the idea is, and something that most new traders get wrong, is they get off kilter in some way on their trade, and the trade is going badly in some way, shape, or form, and then they like hammer the other direction, right? Or they hammer the losing direction, and then what happens? And the market typically reverses, and you lose on both trades, right? So we're going to talk about the Greeks maybe next week. We're going to talk about managing by the numbers, right? This delta, theta, gamma, vega here. We're going to talk about what all that means and how to like do different adjustments to, wiggle your numbers to a point where they're acceptable to you, right? But just know that, and that's really important. It's something that, I'm very, not stern about, but it's something that I care a lot about with students that I'm working with, is like, I don't ever want to see an overreaction, call it an overreaction to a losing trade, right? In terms of like adding new positions on top of it. So it just turns into a mess.
Yeah, and I would just say, like, many people, when they think about options or they hear options, they think that options are risky. And when you come and train with us, we're going to align you not only with our experience, but some great education that's out there that we've vetted, that will show you that options, investing and trading using options, is actually a lot less risky than having your money in the market, because you can go to zero, right? A stock, and look what we saw over the past couple of weeks. I mean, Occidental, I don't know where it's at today, but there was a few days where it was down 50%, right? And if you had a stop loss and there was a gap between where the market ended the previous day and where it opened, you could have had taken a really, really big loss there without maybe even anticipating that you would have that loss. So options offers a lot more safety, and that's what we show our students.
Yeah, and exactly. Like if you know what you're doing, I'm not going to sit here and tell you I don't have losing trades, like I do.
Yeah.
But I don't have those, almost like I'm not getting hit with haymakers. Like I'm not having those plays that just take you out of the knees and deplete a quarter of your account type plays, right? I mean, that's the fear with options. If you're not doing them correctly, if you're doing credit spreads, and you get caught sideways, and you don't know how to adapt to that, right? That's where this kind of options are risky comes from. People who don't know what they're doing, right? Getting beat up.
Yeah, and I see somebody on the screen said they wanted to talk about, how do I buy in a down market? And sure. Dan, I wouldn't even categorize what we're seeing right now as a down market. I would categorize yes, certainly, we've come down from a Dow, the Dow right now is at 21,500. So it's a lot less than it was on February 19th. What we're seeing here is a lot different than we've seen in previous markets. We're seeing crazy swings. And some people think like, oh my God, the market was up, Dow was up 1,700. That's great. The Dow is up today, 800. That's great. We're going to see swings. This is going to be uncertain until these swings cease, or the air gets let out of this balloon. How would you comment on that?
Yeah. Yeah, look, there's many ways to make money in a down market. There's taking it directionally down. Yeah, I wouldn't say this is like a down. The market is down, right? when we say like making money in a down market, you think more along the lines of like a slow, steady, gradual decrease in, almost like a, I don't know if you see my hand, but just kind of like
and that's not what we're seeing at all.
We're seeing this, and then this, and then this, and then this, and then this. And it is down. It's down a lot. But I would call this, rather than a down market, more like, hey, this is like a volatile market, because going back to my chart, again, this is just a dummy account that I use for teaching. But so let's look at a daily chart. Let's do a weekly chart. You know what? Let's do a 10-year chart. This is the last 10 years, okay? S&P 500. I like the 10-year because it shows, that is a nice gradual. It's
an up market, bullish market.
A little bit of scaredness, kind of turbulent times, in here in 2015 there was some stuff going on, election coming up and some other weird things, and now back to a normal market, and then we start to get choppy, right? Choppy, and then we kind of sorted ourselves out, and now we're here. So, I mean, I can pull up a down market if we want to go look at like, one of the last recessions, but it would look different. It would look much different. This is like a what is this market type of market. But to answer your question from earlier, I'll show you, you know what, I'm going to skip ahead a little bit, Dawn, and I'm not going to cover the Fibonacci's right now. I'll cover them at the end. But I want to show you, we'll send you these slides. This is just a quick little definitions, delta, theta, vega. We'll send you guys this. This was the trade, to your question of how do we make money in a down market. So think of it like, I don't like to use the term placing a bet, but we're going to call it placing a bet. This is the bet we're making, okay, on how we're going to make money in a down market. Without going into the detail at first, I'll say to you, as long as, if the market goes down 25% or less, so if it goes down 25, as long as it doesn't go down 26%, right? If the market goes down 25% or 24% or up 1%, and you make 14% on your money by June 19th. Is that a bet you'd be willing to take? Think about that. Like, don't answer right now. Just like think about it. So again, if the markets go down, I'm placing this bet. If the markets go down 20, I forget the number, Don, so 25%, right? We were covering on Monday. If the markets go down 25% down to 165, right, in the SPY. Remember, this is where the actual market
right. So the SPY right now is at 250.
Yeah. So the SPY would have to go down. I got to like shrink my chart. The SPY would have to go down on this blue line here. Okay. And as long as that doesn't happen, I make 14% by middle of June. Does that sound like a good way to make money in a down market? Like, the markets can bounce around as much as they want, right? But if as long as they don't go past that line by June, we make our 14%.
I love it. Show me, and I know we did this in class on Monday, where we got that blue line.
That blue line is the 165.
Right. So that was the lowest it went. I think we looked at a 3-year on the SPY, and that was even below the lowest that it's been. Right.
So how do we choose where to put that?
Right.
Yeah. Let's go. We got to go to like a weekly. We got to go to a monthly actually to see that. Yeah. So we identified this zone, and then guys, we'll talk about support and resistance, but this is like a traditional support level. You see how price was going up, came down, bounced off this level, came back up, bounced on the level again, bounced on the level again.
Right. So this was in 2016.
Yeah, this was like it bounced. The first time it bounced was like 2014, and then 2015, and then 2016, early 2016. But it bounced in the same level 3 times. So that is an indicator for us that most likely there's a large number of buy orders sitting there from large institutions or whatnot, or there's some consolidation of orders sitting in that area, which then causes price to, not be able to breach it.
Let's repeat that, because that's really key. And that was a big thing that I really understood after working with you, is what that shows us is there is a large portion of institutional limit orders that are buy orders that are sitting at that level, because that's the only
most likely
entity, right? Most likely, right? Because you know, news fluctuates. So what we can rely on is the fact that institutions place large amounts of limit orders.
And so that's why I gave this even more room. So the bottom end of this support zone is 180. You can see on the right hand side it's about 180. And again, we're not, you know, we're not hurt until 160, really, right? So, you know, we've identified this area. If it breaches this area, we'll look to get out of our trade, right, for a loss. But you still have, you know, always giving yourself wiggle room, always giving yourself, you know, a chance to get out of it. It says my internet connection is unstable. Can you guys still hear me?
Yeah, that's better. That's better.
It's better? Yeah, I don't know what's going on. All the bandwidth in San Diego is going to Netflix because everybody's staying home this week. Cool. So, and again, just to review that, just to review that trade again, we put that trade on Monday. It's already up 5.9%. As of last night, it's probably up more than that now because the markets went up again. If you want to see, if I unblock this, so this is what we got in at 125. If I unlock this, we're at 72. So it's at 73 last night. So it's up about 6%.
You're going in and out, but yeah, we see that. Yeah, cool.
Yeah, we're about 6%. So going back to another, what was I going to talk about? The Fibonacci. Going back to another indicator that I use, and you can see it over here. What is this weird thing? That's called the Fibonacci retracement. Fibonacci was an Italian mathematician. I don't even know from when. A long time ago, before they had cameras. And he came up with this mathematical sort of like zones. And there's many different things in the world as we see them that follow this pattern.
Yeah.
Even
how, right, rotation of the Earth, solar system, how nature, yes.
And for whatever reason, it works on the stock market too. I mean, honestly, it's weird that it does work, but let me show you real quick how to draw it, the levels I look at, and you guys can go draw your own. What is a Fibonacci? This is how you draw it. You take a recent large movement. You put one plot. If you're using Thinkorswim, it's right here. Drawing tools. Ooh, drawing tools. It's this one. Okay. Fibonacci retracement. Okay. Click up here because that's my top, my big movement down. You click down here. That's the bottom, the recent bottom, and it gives you all these little levels in the middle. Now, specifically, right? You'll notice that I have them all on. Right, I have them all selected. So what do these levels mean? These levels are more likely turning points for stock. Oh, I'm getting some chat here. Chat.
Oh, Lauren is saying Fibonacci, I love my engineer, my fellow engineer, was born in 1170.
Wow, a long time ago.
So he is 12th and 13th century.
Well, he had the markets figured out. I'll tell you that. I'll tell you that much. But either way, what these lines mean are they're areas to look at, and I've highlighted a few of them for areas where the market is likely to have a turning point. Okay. Let's see here. Prices go down. Right. And I didn't do like this is just like right here, but like you see how these two wicks, I'm gonna zoom in. Didn't it just hit it right on the nose twice?
That's amazing.
2 times, 3 times, 4, like right there, right? Does it do it every time? No. But it's something that, you know, you want to just be mindful of, right? The same thing with the Bollinger Bands. We'll do Bollinger Bands next time. I didn't see a lot of it. like the craziness that's gone on here is just beyond reason. But you'll see that even now, we're kind of struggling again, right in this zone here. You know, up, gap up, big down, big up. Looks like we're through it at this point, but you know, something to be mindful of. It also struggled to get back here, right?
Right. So those V's are turns. Just to, you know, when we see those, you know, the turn in price, that V falling on those lines, that's what's so incredible. So why this is so relevant.
Yeah, if you want it to be a bit cleaner, these ones, the 61 and the 38 are less, you know, they're like less powerful lines. So you can remove those two lines if you just want it to be cleaner on your graph. Like these are the major lines, right? And the other two are more like minor. Still relevant, but this is like, if you want just starting one of these lines in my graph confusing me, just stick with these 5. These are the bigger ones anyway.
So as somebody who's new, what I started doing, Dan, was just throwing up a chart and just watching those candlesticks form and placing a Fibonacci over the chart and just getting more confident around what it is that you're introducing us to, which is the high likelihood of turns happening at those levels. So if somebody wants to ask, well, how do I get more certain around this, or how can I exercise my mind to see patterns? That's how I exercise my mind to see patterns.
Yeah, a lot of this comes down to, right, sheltering yourself a little bit from traditional news sources, focusing more on patterns, the numbers. We didn't get into the Greeks a lot today, but you know, we have time. I can go into them, Dawn. But you know, really just looking at what do the numbers say, right? I don't need to hear the talking heads on TV. You know, let's just look at. I mean, that's noise, right? And we'll get there, right?
Yeah.
Is there any questions?
Yeah. That's what I want to do. I'm going to stop the recording now so people can feel super comfortable that. And just before we go, Dan at Options for Wealth, Dawn at Options